Good morning, everyone. Hello, good morning.
Good morning, sir.
Good morning.
Yeah.
Good morning, sir.
How are you doing today?
Morning, sir. We are fine.
Okay,
Good
Fine,
morning,
sir.
sir.
And you?
fine, thank you. Okay, so apologies for joining the class late. I'm trying to fix my graphics device, so unfortunately, it's still not working. So we may not be able to use the writing pen today. So, but let's see how we can manage the class. So please confirm if you can see my screen.
I can see it.
Okay,
I
thank
can
you.
see it too.
Okay. So, as discussed last week, today we'll be taking the analysis of financial statements. Analysis of financial statements. Okay. So, if I may ask you, when you hear the word analysis of financial statements, what comes to your mind? What do you think about? Hello, are we together? So when you hear the
Financial
word
issues.
financial analysis, yeah, so financial analysis of financial statements are still the same words, right? So when you're asked to talk about financial analysis, so what do you talk about? What what do you think of? So Mr. Is it Mr. or Mrs. Grace Moses? I can see your hands up. You can mute your mic to speak. Grace Moses, you can unmute your mic to speak. Okay, maybe she's not there. Ibrahima Andrews Salimon. Mr. Andrew,
Good morning.
good morning, sir.
Good morning, everybody. To me, I'll see financial analysis or analysis of financial statement as making meaning out of financial statements. When financial statements are prepared, they are prepared basically in figures. So some investors, they are not vast in terms of accounting. So when you're trying to analyze financial statements, you are trying to make meaning out of the figures.
Mr. Temitope, or is it Mrs. Temitope? Can you kindly mute your mic, please?
You're trying to make meaning out of the figures presented so that even investors who are not vast in financial accounting or accounting will be able to know what is happening.
Okay. Okay, any other person who wants to try? Another person? Okay, Mr. Kayode YOS. You can mute your mic to speak.
Good morning, house. I see it as
Good
a
morning.
review. I see it as a review of financial statements
Hello, I
to
can
make
hear.
it.
Can you understand?
It's a review of financial statement to make it interpretable to something like a kind of breaking down of financial statements, tracing them to their various this sub accounts now. That's what I can say, sir.
Okay. So another person? Okay.
This-
So,
I don't
Mr.
get the
Alfred,
question. Yeah, I'm trying
the
to
que-
understand the question, sir.
okay. So the question is, if you're asked to talk about financial analysis or analysis of financial statements, what comes to your mind?
Yeah. In analysis of financial statements, is just to interpret the financial statement to users using the ratios, the relevant ratios, as in to tell the purpose of financial statement is to provide record, is to provide information about the financial position, the financial performance of the entity, in order for them to make economic decision. So what comes to my mind is just to use ratios to interpret or analyze the financial statement.
Okay. So,
Hello,
thank you.
hello, sir.
Okay.
I want to add to what he has just said now.
Okay.
Yes, in addition to everything he has said, I would like to add the fact that we will be using those ratios to be able to compare between two entities, or within the same industry, or between the same entity within different period. If we have those ratios on their own are not adequate, are not enough for us to form any economic decision, except we can compare those ratios perhaps with another entity in the same industry or with the same company, but for we compare one period and another period. That's what I want to add, sir.
Thank you very much for that further explanation. Okay. So, Mr. Benjamin,
Yes, what also comes to my mind is that when using ratios, you want to be able to make an informed decision. That's where you see trends. What is the trend in the industry? What is the trend in our activities? What are the things we need to change to help us to make decisions that will make our organization more profitable and sustainable in the future?
okay. So, that's interesting. So you've said it all. Having financial statement is not enough, but for you to be able to make an informed decision with the financial statement is all it takes to be a financial analyst. Okay. So now the interpretation of ratios, the comparison between the result of one entity and the other entity. Okay. And to be able to use that to make a decision, both immediate and futuristic, is what it takes to be a financial analyst. Okay, so there's difference between compilation of numbers, having to prepare the financial statement, and then interpreting the financial statements. Okay, so in interpreting the financial statements, you look at historical data. For a financial analyst, you look at the historical data and you use that to make a decision about the future. You use that to make decision about the future. So like management accountants or management accountants analysts who uses both the historical and then present data to make decision about the future. So here we'll be talking about ratio analysis. Okay, so in our ratio analysis, you are looking at profitability ratios, You are looking at liquidity ratios. You are looking at quick ratio. You are looking at debt to equity ratio, you know, among others. These ratios, you are looking at leverage ratios, among others. So these ratios has its different use. Okay, when are you going to use your profitability ratios? Which of the ratio under the profitability ratio do you want to use, or is it useful for you to make a particular decision? So if I may ask, you want to make a decision about your uh so let's say you want to make a decision about, let's say, profitability, okay, using historical data, what ratio comes to your mind first? Okay, let's say in your exam, the examiner asks a general question that compute the profitability ratio for ABC Limited or Onye Nigeria PLC. So what ratio comes to your mind first under the profitability ratios?
Gross, gross profit ratio and net profit ratio.
Okay, so we have the gross profit margin ratio, we have the net profit margin ratios. Any other ratio?
Rules.
So we
Return
have
on
the
Return
capital
on
employed.
capital employed.
any other one? Any other one? Okay, so if you want to get your asset turnover,
Return on
Residual income
assets.
ratio.
okay, you have return on assets, you have residual income ratio, among others. Okay, so that's then mean that in exam, okay, under exam condition, you need to be way more aware. You need to be more aware of what ratio is specific is the examiner asking of. Okay, so you need to be much aware of what ratio is the examiner specific about. So if you look at my screen, can someone read the requirement of this question? If you can see my screen, can you read the requirement of this question?
Calculate the ratios of Onye Nigeria PLC for years 2019 and 2020. B. Analyze the performance and liquidity of Onye Nigeria PLC for year 2020. C. Comment on the limitations of use of accounting ratios in financial statement analysis.
So which was the first thing we did, Abby, when we talk about financial analysis? So here, the examiner is specific about the ratios. What are the limitations of the use of accounting ratios in financial statement analysis? Okay, so we have trend analysis, you have different types of financial analysis metrics that you can use. So you have year-on-year comparison. So, but most importantly is for you to be able to interpret your financial statements, you must compare one data to the other. Okay, so it could be comparing one entity in a particular industry with another entity in the same industry, or comparing one entity in a particular industry, okay, with another entity of the same size, okay, in another industry. So maybe your research is about looking at how small companies are doing, okay, in different industry. Okay, so that's where you are doing industry comparison. So here now the examiner did not tell us which of the ratios should we use, other than saying analyze the performance. So, and then liquidity. So when you're asked to do performance analysis, what comes to your mind? Performance analysis. What comes to your mind? Is it you using the balance sheet data, or which data do you use for performance analysis?
It's income statement. That is the fee and head account. Statement of profit or loss account.
Okay. So
income
you
statement of different years.
okay. So then the liquidity
Income statement of different years, my
Is
opinion.
the liquidity is statement of financial position.
Exactly.
so you use the statement of financial
Financial.
position. Okay, but also you will also have to
Let's
use
just say we need,
okay, go on. Go on.
yeah, let's just say we need both. We need both the income statement and the statement of financial position to be able to
Perfect.
adequately compute all the ratios that are required.
So when you are talk about performance ratio, so that's your profitability ratio. So which someone mentioned that you use the income statements. Okay. So however, there are some performance ratio that you also have to borrow you know from the balance sheet, like you want to do your return on capital employed. Okay. So or you want to do your asset turnover ratio. So you have to borrow from both primary financial statements. Then more so for the liquidity position, so that's where you talk about your gen ratio, quick ratio, among others. Sorry, a minute, please.
So we can't hear you, please.
He took permission. He said a
You,
minute,
you
please.
took permission instead a minute.
Okay, okay. All right.
Hello. Sorry, I'm back. Can you hear me?
You're welcome, sir.
Yes, sir.
Okay, sorry, apologies.
Yes, sir.
Okay, so as I was saying, so there are some instances that you may have to borrow, from both the uh, income statement and the statement of financial position. But the bone of contention here is for you to know what exactly you need to do. Okay, it's for you to know what exactly to do. So, in some cases, you may be given some of the ratio, okay, at the back of your question paper. But then one thing is to have the ratios, another thing is to know where and when to use them. Do you understand? So one thing is to what is to have the ratios, another thing is to know when and where to use them. So now looking at this question, okay, so let's dissect the question. So we didn't have much story, so there's no need to read the stories. Okay, so now, so we have all of this. Profit before tax is after charging. Okay, so we are giving revenue, cost of sales, and profit before taxation. Okay, so and they are telling us that to arrive at this profit before tax, they have charged depreciation, interest on loan notes, interest on bank overdraft. Then also they gave us the latest average ratios in the industry, right? So that will assist us in our comparison, right? So say for instance, now I need to do maybe my revenue ratio, for instance. Okay, so I do for 2020 and I do for 2019. Okay, so now here they have given me how entities, okay, in this industry perform on average. So this will assist me in my interpretation, okay, of let's say, so let's do our net profit margin, for instance. So if you are doing net profit margin, so what would be the formula to use? So please let's do this together. So if you are doing net profit margin, what's the formula you use? Hello, can you hear me?
I think it's
Profit after tax.
profit
Profit
over
after
profit
tax
after all of our
over
sales.
turnover
So profit after tax,
times 100/1.
profit after tax divided by revenue times 100/1. Is that what I had?
Yes, sir.
Yes, sir.
Okay. So can someone punches our calculator to do that for us? So what's our profit after tax here? So here we're only giving profit before tax. So do we have additional information to, so let's see together. So this is our statement of financial position. Then we have an extract of statement of profit or loss, revenue, cost of sales, profit before taxation. Then again, profit before tax is after charging this. Then so when you don't have profit after tax, what then do you use?
Profit before tax.
Hmm?
We
What
use
do you
profit
use?
before tax.
So you use profit before tax. So can someone do that for us? Hello,
So I think it's 4,157.
64,000. So let me see if I can use example.
4,152.
No, so this is what you are doing. Just wait. So you take, so let me see if I can type in. Let me create additional line here. So can you see my screen?
Yes, sir.
So we want to do net profits margin. Okay. So equals to, so you either use, okay, so if you are doing net profits margin, so for us to get our net profits, so we have the profits before tax, right? Now it depends. So in some entity, the profit before tax is arrived at after charging interest and then some other maybe miscellaneous income and the likes. Okay, so now coming to accounting, okay, at times profits before tax may be slightly different from profits from net profits with interest, with you backing out interest, okay, with you backing out interest. So now that's you arriving at your net profit before finance income and finance cost. Okay, so interest is like finance cost. Are we together? So if that is the case, so and they have deducted depreciation before arriving at this 290, they have deducted audit fees before arriving at this 290. So it therefore means that we add back this 360 and 68 being the finance cost that we have in the question. Do you understand? So hello, are we together?
Yes, sir.
No, sir. Please, can you repeat?
Okay. So in a typical financial statement, if you look at your income statement, right? So your gross profit is arrived at after considering your revenue and cost of sales, right? That one is clear to everyone. Then with respect to net profit, okay. So the net profit is after charging your administrative expenses and distribution costs. Am I correct? Hello, am I correct?
Yes, sir. Yes, sir.
Yes, sir.
So then after arriving at your net profit, you then bring in your finance costs or your finance income. Am I correct? So after charging the finance cost, you arrive at your profit before tax. Then you bring in taxation. Okay. And if you agree with me, part of your distribution cost or your administrative cost is your depreciation, right? And likewise, your audit fee is also part of your administrative fees or administrative costs, administrative expenses. Am I correct?
Yes, sir.
So now
Yes.
the essence of this additional information now is to assist us in our net profit margin. Okay, to assist us in our net profit margin. So to get that, we say we pick this profit before taxation and add back the finance costs to arrive at our net profit. Do you understand?
Yes, sir.
Okay, so here now we have to add 293 plus 360 plus 68. So what's the answer, please?
2521.
Sorry?
2521.
2521.
Yes.
2521. Okay, sorry. This interest on bank overdraft, we go to bank charges, and bank charges fall under administrative expenses. So we don't consider bank charges as finance costs. Okay. So what you consider as finance costs is interest on loan, interest on lease liability, among others. Do you understand? So interest on bank overdraft is like bank charges because it's a recurring expenses. Hello.
Yes, we're
Hello.
hearing you, sir.
Okay. So back out this 68.
Two,
2453.
24533.
We have 2453. So our net profit margin. What's the formula for net profit margin?
Profit before tax over revenue times 100.
So net profit before interest and tax, Abby. Sorry, multiplied by Android divided by one. Okay, so in this case now, what's our revenue? What's our net profit? We have 245.
245.
Okay, so what's our revenue?
5400.
50,
400.
5400. So multiply by 100%. What do we have?
486.
Hmm?
486. 70.
Sorry, sir.
4.86.
Hello,
4.86.
sir. Hello, sir. Please. Sorry to interrupt you.
Okay.
If we say net profit margin is equals to net profit before interest and tax, now
Yeah.
that amount you use, I thought we already have interest in it.
So we said before interest. So for us to have interest in it, is like us saying this 2453 minus the interest. So we said before interest. So here we are giving additional information. Okay. This is our profit before tax, right? For
Yes,
20.
sir.
Now, they didn't tell us that it is profit before interest and tax, but they said profit before tax. So it means they have deducted interest before arriving at this figure. And that is clear in this additional information that the profit before tax is after charging depreciation, interest on loan notes, interest on bank overdraft, audit fees. Then, so we conclude that depreciation is administrative expenses, audit fees, administrative expenses, interest on bank overdraft, which is like bank charges on your overdraft, is also what is also an administrative expenses. Do you understand? So, in that case, for us to get our net profits, it's usually the gross profit less administrative expenses, distribution costs, and any other operating expenses. Am I correct?
Yes, sir.
So after getting your net profit, then to get your profit before tax. So that your net profit is the same thing as your profit before interest and tax. Do you understand? So to get your profit before tax, you have to charge your finance costs. Okay, you consider your finance costs and then your finance income, which in this case is the interest on loan notes that we have. So if this amount is net of interest, for us to get the interest and the net profit before interest, so it's by us adding back the interest, assuming that the interest have not been deducted. Do you understand that? Hello, sir. Is it
Okay.
clear now?
Yes.
Okay. So this one now is for 2020. So this one now is for 2020, right? Yes. So we need to do for 2019. So how do I have the profits before interest and tax for 2019? Can someone tell us? 1440 plus what?
B plus
Plus 270.
70
Plus 270.
divided by 43875.
Sorry. So what do you call the figure again?
1440
Plus 270.
One
plus 270.
one 442 like this.
440
440
Mm-hmm.
plus
plus
270
270.
Divided by what?
1,700.
43875.
43,875.
10.
43,875. What do we have?
4% approximately.
4 points.
Approximately 4%.
You didn't approximate the first one. You need to be careful.
This one is 5% approximately.
No, don't let us approximate like that. We can leave it at 2 decimal points. So this is the idea. You can see that the one they gave us, they left it at 2 decimal points. Abi? So let's leave it at 2 decimal points. So what do we have if we are not approximating? It will be 3 point what or 4 point what?
90. 3.90.
3.90. Okay. Now, what's the net profit margin? The industry net profit margin is 4.73. So the net profit margin in the industry is 4.73. So that one, we use that when we are doing our write-up. But let's try one other ratio before we go to how to put down
Interpretation,
the
sir.
interpretation. Okay. So now,
So please, can we interpret this one now?
okay, yeah, no problem. So before I speak on it, so now let me ask you, just someone. I need just one person. So if you are to
Yeah.
interpret these two ratios, and sorry, these two data, how do you interpret it? 2019 we have 3.90, 2020 we have 4.86. How do you interpret it?
Are we comparing to industrial average or between
We just
years?
compare the 2 years first. So we go back to the industry.
The company performed better in 2020 than 2019.
Why?
There's an improvement in net profit from 3.9% to 4.86%.
Okay. So when you are doing your interpretation of financial data, okay, so you don't just limit it to what you have here. Okay. So
Okay, can I speak?
okay, sir.
All right. So let me just continue from where he stopped. He already said that the 2020 performed um, better than the 2019. This performance can be attributed to possibly um, there was more careful when it comes to um, costs. I think they minimized their costs in 2020. That could have led to the high net profit margin that we can see in 2020. And when compared to the industry average, we can see that the company measured up to it. I think the industry average is about 4.3 something. So the company met the industry average and even surpassed it, if I can remember.
The industry average is
Okay,
4.7.
so yeah, so they met it, they even surpassed it. So in overall sense, the company performed a lot better in 2020 than in 2019.
Okay. So I also expected to mention that revenue increased in 2020 than 2019, right? So
Yes, sir.
you can just do a so you see the interpretation of financial statements um is not a one-way approach. Okay. So I may say something different and you say something different and we still get the same mark for it. Do you understand? So for instance, I may say that yes, the company's net profits margin in 2020 of 4.86% is better than the 3.90% in 2019 due to the fact that the revenue for 2020 grew up by, so you can do a comparison of the revenue, you understand? So this should be like, um, is it up to 10%? Is it up to 15%? Can someone just do 50,400 minus 43,875 divided by 43,875? Okay, so you can say due to the increase in revenue of about 15%, okay, and then if you look at the difference between these profits, okay, so I can't really remember when we added 140 plus 270, what do we have? It should be around 1710. Am I correct? So
Yes.
Yes.
so if you compare 2453 and 1710, okay, so you say that the company performance in 2020 is much better than 2019 as a result of uh, a maybe 12% increase in revenue, which also led to the increase of about. So when you have done the comparison, you can say the increase of about 15% in the net profit when compared to 2019. Do you understand? That's one part. You can say that the way I've interpreted it is different from how you have interpreted yours. Okay, but it doesn't mean that you won't have your score. So the bone of contention is, does it make sense? Okay, so I have said that the increase in the net profit margin was due to the increase in revenue. Okay, now I will not stop at the increase in revenue. I also have to look at the cost of sales too. Do you understand? Or if I have an overview of the operating expense, okay, so I can say that the company, try to minimize their expenses in 2020. Okay, so maybe the operating expense in 2020 is like maybe 1,000 naira. Why in 2019 the operating expense is maybe 1,500? Do you understand? So this also will contribute to the net profit margin. Do you understand? Then when you talk about cost of sales, it could be that in 2020, the percentage of their cost of sales to revenue, okay, let's say maybe in 2020, the percentage of cost of sales to revenue is 30%. Meanwhile, in 2019, the percentage of cost of sales to revenue is maybe 40%. Do you understand? So these are other metrics or other factors that could contribute to the net profit in 20 being better than 2019. But in your conclusion, okay, you then say that from the analysis above, okay, it is obvious that the company's performance in 2020, okay, is better than 2019 and even above the industry average of 4.73. Have I make any sense to you?
Yes, sir.
Yes, sir.
So, number one thing is your introduction, and another thing is what is how you conclude on your analysis. Okay, so it's not enough for me to say yes, the net profit margin in 2020 is better than 2019 with a difference of, or with an increase of, you take the difference between 4.86 and 3.9. Okay, with an increase of that would be around is up to 1%. Okay, so you can say with an increase of about 1%. Okay, so this is largely due to the increase in revenue of about, or you can put the amount safe, the increase in revenue from 43,875 in 2019 to 5,400 in 2020. Okay, you can see that instead of using a percentage increase, I decide to use what? I decide to mention the amount. of the revenue in 2019 and the amount of revenue in 2020. Okay, so you can then say further, which is about 15% or 12% increase. Okay, so this has an impact on the net profit as the cost of sales. As the cost of sales, you know, as the cost of sales maybe reduce, okay, or you can say that the percentage increase on the cost of sales compared to revenue is 2% or 5%, which means that the company does not spend much on cost of sales in 2020 unlike 2019. So it depends on how. So what I'm trying to say here is that there's no one way to interpret the financial statements. Do you understand? So it's not necessary that I must interpret the way only she have interpreted as. It does not mean that I must interpret my own the way God has interpreted his own. Okay, so what matter most is how I've been able to conclude, so that if an independent person is reading whatever I've put down, they also agree with what I've said. They come to the same conclusion with mine. Do you understand? So, and since we are giving an industrial average in this question, so the most important thing is to also be able to compare with the industry average. Okay, by which you can say from all circumstances, okay, it is obvious that the company is doing much better than its PN of 4.86% in 2020 is higher than the net profits margin of 4.73%, and so the industry average of 4.73%. Okay, so there is no examiner that you put that down for that will say, oh, this is rubbish. Okay, because you've already said that the company is doing well in terms of profitability. Okay, so that's looking at the net profits margin. So another thing we have here is we have gross profit margin. Okay, so the gross profit margin is about the revenue and cost of sales. Okay, so when you take out the, can we quickly do that? Or do you want us to move to another ratio instead of gross margin?
Let's move to
So,
another.
so since you have talked about the analysis, that's the for question 2. Can you also maybe talk about the limitation in as regarding this one we've just solved? Then we move
Okay,
to another one.
okay. So I think that's fine. Do we all agree to that? So you have
Yes.
an idea of how to do the interpretation. So what you need now is to then go
Perhaps
and see,
I'm suggesting like
study,
let's
sorry,
just
and
look
study the
at
ratios.
like 3 ratios
So
and talk about the ratio.
you want us to
Please,
do like
can we
three
look at like
ratios?
ratios here and interpret it and move to another one?
Okay, so which of this ratio here now do you want us to do? Gross profits, asset turnover, current ratio, quick ratio, inventory turnover.
We
Maybe
should touch
Jerry
on
ratio.
gearing.
Gearing ratio,
Jerry.
please.
Gearing ratio.
Gearing, yes.
So what's the formula for gearing ratio? Remember, this is a revision class. So again, don't forget this one that we did now is under the performance, Abi. Profitability, performance ratio, Abi. So this one that we want to do, gearing
Yes.
ratio is under what? Gearing ratio is under what? Nobody is talking.
I think it's under liquidity ratio.
Okay.
Gearing, gearing ratio you can be the information can be gotten from the statement of financial position.
It's
So I'm
grouped
not even
under what?
asking about the information. I'm saying, is it a profitability ratio or a liquidity ratio?
It's
Liquidity.
a liquidity ratio.
Liquidity.
Current ratio, is it liquidity ratio or profitability ratio?
Ratio, long-term
Sorry?
financial stability
It's liquidity ratio.
ratio.
Liquidity ratio, quick ratio, liquidity or profitability ratio? Liquidity.
Liquidity.
Trade, trade receivables period, is it liquidity ratio or profitability ratio?
Performance.
It's
Trade,
performance ratio.
trade payables period, liquidity or profitability?
Performance.
Performance.
Performance. So are you saying profitability?
It's not performance.
Profitability, is it the same thing as performance?
So it depends. So I may ask you to tell me how the company is performing in terms of liquidity. So that's why I put profitability in front of it.
Okay.
So don't mind the examiner. They want to double everything for you. So asset turnover, is it profitability or liquidity?
Profitability.
See, profitability.
You want to see the number of times the entity can use the asset to turn revenue, right?
Yes, sir.
Okay. So inventory turnover, uncle. Is it liquidity?
Profitability. Profitability.
Why do you say it's profitability?
It measures the amount of time inventory turns over.
To revenue, right?
Yes.
When to realize the inventory.
Realized profit.
So what's the formula for our gearing ratio?
It's debt
Divided by
all over capital employed
So
multiplied by 100%. Debt over capital employed multiplied by 100%.
I know of debt over equity or
Okay,
divided by debt plus equity.
okay, so our trade receivable and trade payable is liquidity ratio. Okay. So because you want to know for trade receivable, your customer are owing you, right? What number of days will it take them to pay you? Okay. So it means how soon can you recover your cash from customer? The trade payable, how soon can you generate cash to pay your your vendor, to pay your creditor? Okay. So just like we have current ratio and quick ratio, so there are also liquidity ratio. Okay. So yes, you've all said well about the formula for gearing ratio. So you can say it's debt all over. Someone mentioned capital employed, right? So then my next question will be, what is your definition of capital employed? Okay. So if you mentioned that, what was the other formula that you mentioned?
Debt
I would say
all over.
uh,
Debt all over equity. Okay. So now let me ask you for your definition. So if you say that is debt all over capital employed, so how do you divide your capital employed? And if you said it is debt all over equity, so what do you mean by equity? Hello, are we together?
equity is the total amount employed now to do the business. Is still capital.
Equity is the total
So
amount.
which includes, yes, which includes shares, share capital, um, um,
Reserve,
reserves, and
retention,
uh,
Earnings. Returns.
Retained
then
earnings.
also loan
No,
taking.
loan is
No,
not equity.
loan is debt.
It's not equity.
Okay. So
Sir, I want to ask, is it that the examiner will list out the elements of equity? Because in some questions, reserves will not form part of equity depending on how the
so
question is
this is the question
drafted.
that we have, right?
Okay,
This is the
ordinary
question
share
we have.
capital and returns.
So we have ordinary
Is
share
retained
capital.
earning.
So let me just mention something. So you see some formula, right? What they pick is just the equity element. So when you hear about equity, anything that is classified under equity, right? So you can have revaluation reserve, like someone mentioned. What else can you have there? Okay, so you can have um
non-controlling interest.
no
Any
yes, if you have non-controlling interest,
Shareholders.
you have
Shares.
shareholders and fund. Okay. I'm trying to remember something. You can have actuarial reserve. Okay, so
surplus.
it's in sorry, evaluation surplus. Is that what you mentioned? Okay,
Or
so
reserve.
yeah, so anything that you have classified under equity, okay, because you've used the word equity, it's not share capital. Okay, so because some people used to mix the two together by taking share capital as the equity. Okay, so the equity includes share capital, uh, retained earnings, what else again?
Premium.
Option surplus, share premium, thank you,
Reserve.
reserve, among others. So now I have seen some formula that what they consider under their gearing ratio is debt divided by equity plus debt. Do you get? So
Yes.
Yes, yes, sir.
debt, I don't know if you have also come across that. Debt divided by equity plus debt.
I
So
have, sir.
you've seen that too, okay. So and when you talk about capital employed, so your capital employed is just like someone mentioned earlier. So it's like you are still talking about the equity, okay. So not necessarily share capital. So you are still talking about the equity. So then the other variant of the formula is equity plus debt, or you say debt plus equity, anyhow you like. Okay. So what matter most is you getting it right. So now
So,
let's
sir,
try.
who should be the correct one?
So because from different literatures that we've seen, at times I can't even remember the one I used in my exam. You understand? So because even if you have studied the Ican Pathfinder, you see that they've used the two formula. I don't know if you find out they have used the two formula. So for me, to be on the safer side, okay, you can use equity plus debt. Okay, but I will want you to go and do a research. Okay, go and do a research. Maybe you can do from 2014 to 2024. That's 10 years, I mean. So your focus is on ratio analysis, but in particular gearing ratio. Okay, so you can write out the formula they use for each of the years that they or each of the diets they tested gearing ratio. Are we together?
Yes, sir.
So then, if the one they have used most is equity plus debt, okay, it's fine. But what I've noticed again is whoever is the marker Okay. So if you have used capital employed, right? So I'm not sure the examiner should mark you down because it is still acceptable. I don't know if you get what I'm saying. So it's just like this
Yes.
net profit margin. Okay. So here we consider net profit before interest and tax, right? And we're able to explain. If you ask another accountant to come and do it, the person may not even back out interest. Okay. But then it still boils down to how we have interpreted the results. Do you understand? So say for instance, if the person did not back out interest and it still comes to the result of having the 2020 higher than 2019, do you agree with me that the person would have interpreted it the same way you have interpreted this particular one that you back out the interest? Because the 2020 results is still higher than 2019 and even above the industry average. So meaning that the examiner is not only marking your results here, they're also marking how you have interpreted the results. I don't know if it's making sense to you.
Yes.
So if your conclusion is that the company is doing better than its peer in the industry, given the fact that it has, maybe in its one case, it has 5.0, and 5.0 is still more than 4.73 that they have in the industry average, and even more than 2019. If we still have, if what they have allocated to the interpretation is 4%, and sorry, is 4 mark, we have is 4 mark. Do you understand? So now, if we do this first one, what will be the results? If we do the second one, what will be the results? So the difference will just be us adding these loan notes, right, to this equity, which is 36 plus 5603, right? Then for 20, adding 27 plus 36 and 3938. So that's if you are using this second formula, debt divided by equity plus debt. And if you are using the debt divided by capital employed, which is the equity, so it means you don't need to add the 36, right? So you only pick 36 plus 5603, 36 plus 3938. Is it making sense to you? And it's just one person that you can stream in.
Okay. Sorry, sir. If I may understand
That
what you
debt, can
said.
you tell us?
Sorry, if I may understand what you said, that if we are using capital employed, we just only pick the share, ordinary share capital and the retains earning, right?
In this question. So in another question, the element of equity may be more than 2. So that's why I said you consider everything that is under equity. Do you understand? That's if you are using
Okay, sir.
capital employed. But if you are using equity and debt, so you pick your equity, then you add the debt. So it's not you're adding everything under non-current liability. You are only adding the debt portion under the non-current liability. Do you understand?
Yes, sir.
I think
In this,
we should look at
yeah,
what that equity really means. Oh.
Sorry?
I think we should
in this,
really carefully look at what the equity really means. My understanding about equity is the residual value after liability has been taken from the asset. So what
Yes.
is left is equity. That is
Yes.
total asset minus total liability. So
your
the
point.
equity, yes.
So,
I want to add. I want to add.
okay.
I think each question that will be given will have specific information. And for
Mm-hmm.
this question, for instance, under equity, what I can see is just share capital and retained earnings. I
Mm-hmm.
don't think we are going to use another question may give us additional information.
Mm-hmm.
Maybe where you have a long-term debt and that, all that. But in general, they said is debt plus equity.
Okay, so Just like the first man said that equity is the residual value after taking liability from total assets, total liability from total assets. Yes, you are very much correct. And in every question that you have, okay, in as much that you have a complete statement of financial position, okay, ordinarily by taking out the total liability from total assets, you will still have your equity, and which may comprise share capital, retained earnings, revaluation reserve, actuarial reserve, just mention. Okay. So in as much that all these elements I mentioned are classified under equity, so whatever approach you've taken to arrive at your equity will still be the same as the addition of everything that I've classified under equity. Do you understand? So whether you take your total assets minus total liability, you still arrive at that residual value, which should be the same as the equity that is shown in the statement of financial position. Okay, so that's why I've said earlier that equity is not just share capital. There are other elements of equity. Okay, so and then um if the formula you are using, I keep saying that it depends on the formula you are using for this gen ratio. If the formula you are using for the gen ratio is equity and debt, it means you add everything under the equity, which is the residual value you mentioned, plus the long-term debt. Okay, plus the long-term debt. And if you have both long-term and short-term debts, debt is debt. Okay, so now the long-term debt, now if you look at another formula, they put it specifically long-term debt. Okay, but if you've mentioned just debt and the question is not specific, whether it is short-term or long-term, just pick it. But if they are specific, okay, so we are not saying that you should come and add bank overdraft. Oh, no, the debt is like you have 10% loan notes, right? In this place, they put it under non-current liability, and you have the same 10% loan notes that they put under current liability. Maybe that's the portion of the loan that is payable within the next 12 months. So in that case, you add the two together, they are both debt. Does that make sense to you? Is that clear?
Yes.
Okay. So now,
Yes, sir, please, but I have a question. What about the debt that is on top before all over the
Exactly.
equity?
Please, which
Is
one
it
are we
not the
going to?
loan that we are supposed to use for it?
can you take it one after the other?
No, I mean, you said if we are using debt over equity plus debt. So I'm
Mm,
saying that the debt up, is it
mm.
the loan that we'll use for it and also use that same loan for up and down?
Yes, now. Is the
Okay.
debt that the amounts, whatever amount you've put as
Up,
your
okay. You also
numerator,
add it equity down. Okay.
you add it to the equity as the denominator.
Okay, sir.
Um,
Thank you.
so assuming there's a preference share, where would that one reflect?
Preference share.
Assuming there's a preference share, where are we going to reflect it on
So
this?
it depends on where they have classified it in your statement of financial position. If the preference share is under equity
Yes.
liability, you understand? And sorry, if it is under equity rather. So that's the preference share that is convertible, right? So
Okay.
that's part of equity. But if it is non-convertible, right? So they will report it under non-current liability. So if it is reported under non-current liability, what is it to you? Is it debt or equity?
I
Hello,
think it's debt. Debt.
Debt.
it is
Debt.
debt, the debt. But if it is reported under equity, what was it? It is equity.
It is.
Okay, sir.
Okay, I think I have a little bit understanding of why this is now debt over equity plus debt, because I feel
Mhm.
that the debt is also adding to the the capital of the organization. That's why it's being considered. I don't know if it makes sense, because if we are looking at capital employed, and then you brought in some money and then you needed more and you have to borrow, so you have also increased your capital.
Mm, 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 mm. Don't interpret it that way. So I may borrow money from Zenith Bank. Does that make Zenith Bank become a shareholder? No.
No, sir. It's a
So
debt. It's a debt actually. It's a
so
debt.
so
But
so
what I'm
step.
saying is that it
No, I
increased.
know, I know where you are coming from, right? I know where you are coming from, but
Okay.
it's not necessarily increasing my equity. Do you understand? So it's not so capital employed. If you have checked, is so it depends on the examiner, right? So my capital employed basically is my total assets less my total liability. But we've seen some literature or some tests just taking it as total asset less current liability. Okay, so if it is total asset less current liability, in that case, debt have been considered, which is why we have this second formula. You understand? But again, we need to be careful that under our non-current liability, we may have other items there. I may have a lease liability, right? I may have trade payable that is not due in the next 12 months. Do you understand? So I may have some other things recorded under my non-current liability. So that's why we need to be careful and clearly define what actually constitutes debt. Do you understand? So now, capital employed, for instance, if I've, you know, maybe enter into a higher purchase, okay, to get a plant for the purpose of production. The plant is not a capital expenditure, it's a capital expenditure. So that's why we have total assets less total liability. So then say equity. So that equity is the residual amount. Okay, is the residual amount. So after taking my total asset and my total liability, right? So total liability is what I am to settle. The total asset is what I have that is generating cash inflow for me. You understand? So, and the net, the net profit or the profit after tax or profit from operation has flown from statement of profit or loss to my equity. Do you understand? So, which is the net position of my performance in the year. So that's my capital employed because whatever asset I have, I've used it to generate revenue. Whatever liability I've incurred has gone to my cost of sales, interest, and the likes. I don't know if
Okay,
that
sir.
makes sense. So
Yes, sir.
you need to look at the circumstance. So you don't just give a general interpretation or general meaning to it. So so now let's look at the limitation before we call it a day. So from what you've seen here, or what we've explained so far, what do you think could be a limitation of accounting ratios, given the fact that we use historical data, right? For these ratios, we use historical data. What are the limitations? Number one, number two, number three, before we call it a day.
Number one, I think historical data, they are not usually accurate in interpretation of them.
Why do you say it's not accurate? Something they have
Because
predicted.
it's already past events.
But that's not the
Mm,
right word.
Okay.
I think for if the financial statement, the one of the limitation of the accounting ratio is that if the financial statement contains error and you now apply the accounting, I mean the financial ratio, it won't be able to
no,
be able to
no,
detect that
no,
error.
no, no, no. We are not using management accounts, audited accounts. It has been audited. So,
Differences
Okay.
differences in accounting policy can affect ratios
mhm,
from
that's
one entity to the other.
yes, because you are comparing entity A and entity B. Say, let's say for instance, now you are doing let's say trade receivable period, right? Now, maybe my policy is or 99% of my sales are on credit. Do you understand? If 99% of my sales are on credit and you are comparing my results or my performance with someone that is doing cash and carry, do you understand? Please, who do you think will be more liquid?
Cash and carry, sir.
The person that is doing cash and carry or pay before service. Okay, because it is unlikely that the person will have trade receivable, right? But comparing that with someone that has 99% of his sales on credit, maybe the person is still begging for people to come and buy, or that's their business approach. When you sell, you pay, we restore, um we replenish your stock, right? So if that is the business approach, you can't compare us in terms of liquidity. And maybe my credit period is say 90 days, and you are comparing me with someone that their credit period is 30 days. So if my credit period is 90 days and you have my receivable that is due maybe 60 days. So in my case, is it past due or still within the period? So it will still be within the period because my receivable days says 90 days. Abby, that is when I can start chasing my customer after 3 months that they have received the goods. So if after 2 months, will you say that my receivable is due?
No,
No.
no.
But for someone that their receivable due date is 30 days and they have not recovered the cash after 45 days, is it overdue or not? So
Overdue.
it is
Overdue.
It's
so in
overdue.
that case, for someone like that, you have to make an impairment loss, Abby, because this thing is due under
Please
IFRS.
mute too so we can hear.
Okay, because it is due under IFRS 9. That 15 days and the person has not paid. So the person did not pay within the period. So you make a provision for it using your age analysis. Okay, so now, like the person said, accounting policy differs. So comparing company A and company B, you can also talk about the capitalization policy. You want to compare someone that their capitalization policy is 5 million with someone that is just 50,000 naira. So that's one part. Then the other part will be historical data. So let me assist you. So because the ratio analysis is using the historical data, right? So you can't really say much about the future, right? So you can't really say much about the future. So and using historical data to predetermine what will happen in the future may not be what may not be accurate. So it's not the data that you are using that is not accurate. Okay. So but using it to predetermine what will happen in the future, okay, so is what you can say that, oh, that may not be accurate. So because in most cases it will be difficult for you to say, okay, this is what will happen at the end of 2025. And in that case, judgment comes in, I mean, assumption comes in, estimation comes in, because it therefore require your judgment to say, oh, if 2020 is better than 2019, then 2021 should be better than 2020. So let's assume someone said, oh, 2020 is better than 2021. And therefore 2023 should be better than 2022 and 2024 should be better than 2023. And on that, you've built your budget on that. And looking at the economic conditions in 2023 and then what's happening presently in Nigeria in 2024, we used to say that your conclusion using the ratio for 2021 and 2022 is appropriate. It may be appropriate
No, sir.
in some instances, and in some other instances, it may not be appropriate. Okay, especially in 2023, we have a lot of companies, even banks, reporting loss. Please mute your mic. Reporting loss because of the exchange rates, because of the inflation, and the likes, removal of fuel subsidy, among others. Okay, so these are the things that you look at. Inflation in 2022 may not be the same in 2023. Okay, so may not be the same in 2024. And if you have used the performance of 2022 to judge 2023 or 2024, so you may not be correct. So in that case, it may be difficult to make an appropriate economic decision. Okay, so because you have to consider the variables. Later on, you have to compare your budgets with the actual. So that's why management accountants, at times we say they don't like cost accountants, or sorry, they don't like financial accountants, because the financial accountants use historical data. Management accountants use both historical and present data to make a decision about the future. So thank you everyone for joining us
Please,
in
I
today's.
want to ask a question. No, sorry. When they say that it can be manipulated by window dressing, what does that mean? Because I don't really understand that.
Okay, so window dressing means that, let's say you want to borrow money from Zenith Bank now, and Zenith Bank have said, oh, you want to see your profitability in 2024 from January to June. You know, it is still unaudited, Abby. So you can say, okay, no problem. We are doing very, very much fine. In fact, we are doing more than our peers in the industry. Okay, so, and because you want to impress Zenith Bank, the sales for July. Okay, you know what they want to say is from January to June. The sales for July, you then decide to, record it in June, so that your profitability in June will be much. So you recorded the sales in June without recording the attributable expenses in June. Do you understand? So in that case, your revenue will be much higher than what you should have reported in June. So thereby increasing your profitability as at the end of June 2024. So that's window dressing, because the matching concept is not there. The cutoff has failed, because the revenue for July should be recorded in July and not June. And if you are taking the revenue for July to June, why are you not taking the attributable expenses to those sales in July to June, so that we can see what you are reporting? So that's window dressing. You saying,
Okay, so we can still use it to answer this C question. Limitations. We can still use it for these limitations.
yes, now you can use it.
Okay.
Yeah, thank you. Thank you everyone for joining the class.
I have a
I wish
question.
you
I just want to ask for
I
this
I need
industrial
to join.
in- excuse me, sir,
Sorry?
please.
Sorry?
I have a question. I want to talk about this industrial average. Is it for this 4.73? Is it for all the ratios? Is that the industrial average for all the ratios? Or
No,
is
no,
it
no,
only
no, no,
for
no. Each of the ratios has their own. You can see
so how do we know are you going to list it for us, please?
the examiner will
Okay, the examiner. Okay.
yeah, the examiner will give you the data. Except the examiner is not asking you to do industrial average.
Okay, sir. All right, thank you, sir.
You're welcome. Okay, thank you. Do enjoy the rest of your weekend. I wish you best of luck in your coming exams. Bye.
Thank you, sir.
Thank you.
Thank you, sir.
Thank you, sir. Thank you, sir.